Between 1973 and 1974, the S&P 500 fell 48%. It was not a crash. It was a sustained, grinding decline over 20 months. By the end of the 1970s, the inflation-adjusted return of the stock market was essentially zero for the entire decade. The 1970s created what economists call the lost decade for equities. The nominal Dow Jones was at 850 in January 1970. It was at 838 in December 1979. 10 years, zero nominal return. Inflation averaged 7.4% per year during that period. Real purchasing power of the Dow down approximately 53% over the decade. The mechanism? Stagflation destroys both bonds and stocks simultaneously. Bonds lose value when inflation rises. Stocks lose value when growth slows. There was nowhere for capital to go, except commodities. Gold went from $35 to $850 between 1970 and 1980. Here is what the historical record shows about investor behavior in this period. From 1970 to 1980, household equity ownership as a share of financial assets fell from 24% to 12%. Investors left the stock market. They did not return in meaningful numbers until the bull market of 1982. The paradox? They left at the bottom. The 1980s were the best decade for equities in modern history. The investors who fled during the lost decade missed the recovery entirely. The lesson is not unique to the 1970s. Every financial crisis produces the same behavior. Maximum exit at maximum pain. Minimum participation at maximum recovery. The S&P 500 has fallen for 3 consecutive weeks, currently at 6,632, a 2026 low. Fears of 1970s-style stagflation are being raised by Capital Economics, Morgan Stanley, and Goldman Sachs. GDP 0.7%, oil $100, inflation above target. The 3 conditions that defined 1973 are all present simultaneously. If investors who fled in the 1970s missed the entire 1980s recovery, and this pattern repeats in every financial crisis, is the primary driver of poor investment returns the market or the investor?